Most of the people I speak to ask me, Ashish, I have some money to invest. Where should I invest? And my first response to them is always, how long do you want to invest? Because this one question changes everything. But before we move ahead, let me introduce myself to those who are new to the channel. Hi, I am Ashish, founder and CEO of SLA FinServe. I've been helping people manage their personal finances over 20 years. Over the years, I've realized something. Most investment mistakes don't happen because of bad products. They happen because of bad structure. And that's exactly what we are going to talk about today. In today's video, we'll discuss how to build a good investment portfolio and what investments you should actually have in it. Most often when we begin investing, we think about which product to invest in because that's what we see people around us doing. There are always conversations about which fund is better, what returns it has delivered, which stock is doing well, and so on. But most people don't stop to think, when will I actually need this one? And when you don't think about the timeline, you start investing without a structure. You invest based on trends, tips, or recent returns. Over time, you end up collecting a bunch of products that may be good individually but don't align with your needs. For example, equities have been doing really well over the last few years. So naturally, everyone wants to invest in equity. And you also end up putting most of your money in equities because that's what everyone around you is doing. Now imagine that after 8 or 10 months, you suddenly need money. Maybe there's an emergency or a business requirement has come up, and unfortunately, the market is down that time. Now, what will you do? You will have to withdraw at a loss. And then you start blaming the investment. But the real issue was not the product. The real issue was that the money didn't get enough time. That's why the time horizon is important. Over the years, I have followed a simple structure that ensures my investors always have money available for different needs, even the ones they did not plan for. And that structure is what I call a ladder-based approach to investing. Now, don't get confused by the term. It's very simple. It just means this: your entire money should not sit in one type of asset. It should be divided based on when you might need it. Think of it like steps of a ladder. Some money is for immediate need, some money is for short-term need, some money is for medium-term needs, and some money is for long-term growth. This is how we structure the portfolios for our investors, where there is money allocated for different time horizons, because you never know when a need may arise. So if you're considering your own portfolio, here's how you can begin. For really short-term needs, always have your money parked in a liquid fund. It's easy to withdraw, usually within a day. These needs are often sudden, like a sudden travel, emergency breakdown of a car or laptop. So this money must be stable and easily accessible, and liquid funds offer you both. Next, park some money for short-term needs that may arise in 1 or 2 years. This can go into debt funds or fixed deposit. These give you stable returns, slightly better than liquid funds, but without much volatility. Then allocate money for medium-term needs, say 3 to 5 years. This portion can be invested in conservative hybrid funds or balanced fund or multi-asset funds. Here the goal is to allow some growth but still manage risk. Finally, allocate money for long-term goals, which are typically 7 to 10 years and beyond. This money should be invested in equities. Equities work best when given time, and this money should not be disturbed for short-term requirement. This is what creates a ladder. Different portions of your money are placed at different levels, so you don't disturb long-term investments for short-term needs, and you don't park long-term money in the low-return investments either. Ask yourself, for what needs have I still not allocated money? Once the timeline is clear, the product becomes much easier to choose. That's how you build a strong and structured investment portfolio. If you found this useful, do share it with someone who keeps asking, where should I invest? And if you have any question, drop them in the comment section below. I'll be happy to address them. I'll see you in the next one.